For a lot of investors, when you talk about Tesla and investing into Tesla, it's usually a big emotional decision. The question typically is, do I like their cars? Do I like Elon Musk and what he stands for? But when you start talking about how many cars Tesla produces every year, then a lot of people don't actually know the answers. And so I can identify with the emotional side of the decision making. I love Tesla cars personally, and my brother owns one. But this week, Tesla reported its quarterly results, and I've seen two different reports land on my desk from Wall Street, and they could not be more different. Deutsche Bank analyst values Tesla at $1,500 per share, basically where we are today. And Citibank, on the other hand, their analyst looks at Tesla and values it at $450 per share, which is a 70% downside from current levels. So if you own Tesla, or if you think about investing in Tesla, you want to stick around for the next 10 minutes because we're going to examine some of the facts and some of the numbers around how Tesla actually makes money and what the valuations should look like. We'll talk about their factory setups, their capacity constraints, their expectations in China, their expectations in terms of production numbers for the next 10 years. And we'll examine a lot of the bullish arguments that are out there. So there's a lot of arguments, a lot of numbers and a lot of charts that we'll go through. So fasten your seatbelts. Welcome back to the channel. My name is Martin Zeman, and for those of you that are new here, I'm a former investment banker, trader, and a hedge fund manager. And Tesla is a company that I've been following for a very long time. One of the reasons has been the quite funny conflict that Elon Musk has had with Wall Street for years, and especially the hedge fund managing community, which has been trying to short the stock for years, and very painfully, obviously. And finally, when the stock started taking off, Elon would send a pair of shorts to David Einhorn, who was the most prominent kind of vocal opponent of Tesla. And recently, Tesla started producing those red shorts that quickly were sold out on their website, kind of to really make the point. So this video is likely the first of many about Tesla that I'm going to make. So make sure you hit the subscribe button below to kind of get notified about the following videos that will be made on this subject. But what I want to do here really is kind of structure this video in the following way. I want to spend a couple minutes talking about the capacity for production and the actual numbers that Tesla has, the different gigafactories they're building around the world, the capacity constraints in terms of how much they can actually produce, and kind of go over some of the highlights of the good news that especially were present in that Deutsche Bank report, which values Tesla at $1,500 per share. And then I'm going to spend some time going through some of the points on that Citibank report, where we're going to examine 5 different arguments, 5 different bullish arguments for Tesla stock, and really kind of shed some light on whether these arguments hold, or whether you can kind of doubt some of the statements and some of the promises that Tesla's making. And finally, at the end of this video, we'll talk about specific valuations of, given what the projections are, and these are kind of undisputed, whether it's Deutsche Bank or Citibank, how do we value where Tesla should be trading at? First of all, let's talk about some of the successes that Tesla has registered in the last quarter, and let's talk about the production numbers and the capacity constraints that they have going forward. So the second quarter has been quite successful in terms of deliveries. Tesla delivered 90,000 cars ahead of schedule on decent profitability. China has been obviously a big success in terms of their production and how they ramp up over there. The whole coronavirus shutdown in the United States mostly has been offset by smart management decisions. So that really half the quarter their factories were closed, but that really didn't affect it in the end all that much. And Tesla still forecasts to deliver about 500,000 cars by the end of 2020. Now, in fact, let's look at this chart here. This is from the Deutsche Bank report. We're looking at the right side of this chart on the revised section, and the middle column, the 2020 estimate for the full year. And if you look down at the gray area, you'll see the deliveries for 2020, which is just shy of 485,000 cars. And below you have the splits, so 350,000 cars for the Model 3, obviously very, very successful. You see them on the roads more and more. And then Model S and Model X respectively, about 25 and 27,000. And then the Model Y, which has been in production for about a year now, at 83,000. Now, I want you to remember this number, this 500,000 cars for 2020. And look to the right here for 2021, the estimation is 688 or 689,000 cars, which is really about 200,000 cars more from 2020 to 2021. And we'll go back to this chart when we talk about the valuation and the multiples and the expectation that investors have when it comes to how many cars Tesla is able to produce, given the capacity constraints they have when it comes to the Gigafactories. Now, we'll talk about the Gigafactories in a second, but looking forward, what really goes for Tesla and the share price right now here is the upcoming inclusion in the S&P 500, which is going to basically means that a lot of the index tracking funds that have to buy whatever's in the S&P 500 will have to own Tesla, which we may have seen front run already by to a certain degree. And then the next event is going to be the Battery Day on the 22nd of September, which is a big deal. That's a huge event that Tesla organizes. And it should really show the increased efficiencies when it comes to the way they package and manufacture the battery units. And that really takes me to the capacity constraints that Tesla is under. Right now, their Gigafactory 1, which is in Nevada, produces most of the battery packs for their Teslas. The capacity at the factory is about 35 gigawatt hours a year. Now, that number doesn't mean anything to most people. But 35 gigawatt hours is about 500,000 cars. That's about the equivalent of how many cars they are able to produce given the capacity in that one factory. So the plan for Tesla is really to ramp up the production of those gigafactories around the world so that they can actually ramp up the production in terms of cars and the other products that they produce in whether it's sunroofs and other storage solutions. Now, the second Gigafactory they have is in the state of New York. The third one is in Shanghai in China. Number 4 is being built in Berlin, and they've made really good progress. And number 5 has just been approved in Texas. That's going to be Giga Texas, and it's going to mostly produce cars for eastern United States. Now, looking back at some more highlights and the outlook for the next 5 years. So again, going back to this chart, we're looking at 500,000 cars in 2020. And the deliveries for the second quarter in 2020 were about 90,000 cars. Tesla informed their employees that they want to beat all the records when it comes to the deliveries in the third quarter of 2020. So far, the biggest amount of cars produced in one quarter was in the last quarter of 2019. That was 112,000 cars. And this very optimistic Deutsche Bank report is writing about the fact that they should be able to produce 140,000 cars in the third quarter of 2020. And they're looking at about 2 million cars by 2025. Again, we'll talk about these capacity constraints and the amount of cars they have to be producing at a certain margin to justify the current valuation at the end of this video. So with all of this good news out of the way finally, and the positive highlights for Tesla, let's look at why Citibank values the company at $450 per share and why they are so negative on the performance of the stock going forward. So what Citibank does in the report is they present 5 different bullish arguments and views that most investors put forward when they justify the current valuations, and they examine each and every one of them. So the first argument that they look at is that Tesla has achieved a so-called escape velocity, that they have a dominant market share with outsized returns, that they basically act as a disruptor in the same way that Apple, when they started producing iPhones, and that Tesla has no competition at this point. So if you examine the statement, you can let's look at the US market, because that's the market where Tesla has been the longest. In the US, the Model 3, which is really the success story of Tesla, with 350,000 cars out of 500,000 cars in 2020, that Model 3 has been in production for the last 3 years. Model Y has been in production for the last 12 months. Now, clearly Tesla is the leading brand in the US, and they encouraged electric vehicle purchases by subsidies and incentives. So all of that is true, but even against all of this effort and the brand penetration in the general market, you can argue that the adoption of electric vehicles by most people has been quite slow. In fact, I'm going to put up 2 charts next to me here. The first chart shows the US sales of electric vehicles since 2011 to 2019, and you see that dip from 2018 to 2019. So that penetration of the market and that dominant position is not necessarily true. Now, the second chart here shows the sales in China of electric vehicles from 2018 and 19. Now, you see also that decline in the late stages there. And China represents 60% of all electric vehicle sales worldwide. So China is a huge market for any brand that's producing electric cars. What happened in China is they effectively lowered the subsidies for these cars, and customers and consumers went back to the regular internal combustion engine cars. Now, to the argument of competition, it's true that Tesla leads in areas like EV propulsion, electric vehicle propulsion, the way they distribute the energy to the wheels, and what they call OTA, the over-the-air updates, which is basically the updates to the software of the car that people get through their Wi-Fi, or the whole electric architecture. But there's a lot of leading brands now and new brands that are bringing cars to the market with really cool updates and features, from infotainment to head-up displays to the L2 Plus sensors. The L2 Plus is basically the way the car sees around itself, and we'll see later. I'll talk about why Tesla actually is behind the competition in this area. And finally, the most overlooked opportunity in the market, and why we haven't seen such a deep penetration, and why there's just not more cars on the roads that are electric cars, is the rideshare deployment. At some point, Lyft and Uber will partner with somebody and deploy electric vehicles that will have autonomous driving, and that's a huge opportunity that Tesla may not be able to benefit from, because their intention is to build their own network in time. So this whole argument that they have a dominant position and that there's no competition is not exactly accurate. Let's now look at the 4 other bullish arguments that people put forward and that Citibank disputes in the report. So the second argument on the bullish side is that Tesla's second quarter delivery basically beat consensus, that the company completely decoupled from the rest of the car industry's downturn that the whole industry is going through currently, and that the whole China story was underappreciated. So Citibank actually agrees that the whole China story is a big success. That's not disputed, but they argue that Tesla really didn't race ahead of the rest of the car industry. Car companies like Ford and GM did really quite well in the second quarter. So this whole argument that Tesla is really well ahead of the competition in terms of how they have much stronger demand and how many deliveries they achieved in the second quarter doesn't make any sense here. Now, the third argument on the bullish side is a big deal. It's all about the full self-driving and the autonomous vehicle being a major opportunity for the stock. Now, Tesla is really strong in the OTA, the over-the-air updates, and the whole software, and that should really be the biggest strength for the company. But they made a couple of mistakes in how they arranged the whole system. First of all, they selected a sensor set that is likely going to fall short of the acceptable industry performance standards for L4 robotaxi services. Now, the L4 is a level of safety. There's 6 levels from level 1 to level 6. Level 4 is basically what is required for the taxi driving services without a driver, the robotaxis. So right now, the best practices call for the kind of safety metrics that are somewhere between 100 and 1,000 times the performance of a human. And the sensors that Tesla installed in their cars, they lack this whole surround redundancy, which is all about the 4-corner radars, the LiDAR sensors, the next-gen imaging radars, and the night vision. Now, the second mistake in this area that Tesla is making is that they are pre-selling those L4 and L5 features on the current hardware that they're putting in the cars, which basically prevents them from ever upgrading or having the ability to upgrade the sensors when they need to, when they have better technology. So when you look at some of the other cars that are going into this whole L4 robotaxi services, companies like Waymo from Alphabet, Google, or Cruise from General Motors, GM, or Aptiv or Zoox. Zoox was bought by Amazon. So you have really big companies with deep pockets that are going in this area and that already have this capability. So it's not completely hopeless for Tesla in this area, and they can catch up. But the whole argument that the full self-driving, the autopilot, is the selling point and why the valuation should be where it is doesn't also make sense. Now, the argument number 4 is that their financials improved a lot from where they were a year or two ago. Now, Citibank agrees with the fact that their gross margins, which were a disaster at the beginning of 2019, really improved in a big way. But to compensate and to achieve these improvements, Tesla actually limited some of the spending in the research and development, which kind of starts a whole new debate around the quality of the earnings. And finally, the biggest argument that people put forward on the bullish side is that Tesla should be valued as a tech stock and not as a car stock. Now, Citibank agrees that we could talk about this if their position was really dominant in the whole full self-driving autonomous vehicle capabilities. But when they compare Tesla to the tech companies, they basically state that Tesla doesn't compare when it comes to the gross margin, the R&D spending, the research and development spending trajectory, the capital intensity, and the free cash flow metrics. And so finally, Citibank's argument is basically that it's not about being bullish or bearish at this point, but it's about the risk reward. And the risk side of the equation here is that Tesla ultimately gets re-rated to the same multiples that other car companies are priced at. And not the multiples that they have at the moment, which is basically on par with tech companies. So that's it for the 5 bullish arguments that investors put forward when they justify the current valuations of Tesla, and how Citibank kind of disputes them one by one, which really leads me to the valuations that Citibank is putting forward and how they analyze and look at what the valuation should be for Tesla. So what Citibank does is they examine 3 different scenarios, a base case scenario, a bullish case scenario, and a bearish case scenario. So in the base case scenario, to which Citibank attributes a 70% chance of happening, they assume that Tesla in 2030 is going to be making 4.5 million cars. And again, think back to the chart we had at the beginning of this video where Tesla is forecast to make 500,000 cars in 2020 and 700,000 cars in 2021. So by 2030, Tesla would be making 4.5 million cars at an average sales price of $40,000 at 10% margin. Now, if you apply an 18 price to earnings multiple to those numbers, and by the way, 18 is still quite a bit higher than the average auto industry PE multiple that is normally used to companies like Ford or GM. But when you apply the 18 multiple to those numbers and discount all of this back to today, you arrive at about $450 per share price. So that's how Citibank arrives at their target, which obviously is quite a bit lower than where we are today, trading at $14 or $15 or $1,600 on Tesla. Now the bullish case, to which they attribute a 15% chance of happening, assumes that Tesla will be making 9 million cars by 2030 at an average sales price of $35,000 per car at a 10% margin. And if you apply a 20 multiple, so a little bit higher than in the base case, so 20 PE multiple to those numbers and discount back to today, you're going to get about $838 per share. So about half of where Tesla's trading today, again. And that's the bullish case scenario. And then finally, the bear case scenario, also 15% chance of happening, is assuming that by 2030, Tesla will be making 1.5 million cars. So still 3 times as much as they are making today, at selling them at $45,000 each, average sales price, and having a slightly higher margin of 12% instead of 10% in the 2 other scenarios. And then again, applying an 18 price to earnings multiple to those numbers and discounting back to today, in that bearish case scenario gets us to a share price of $182. So really quite low. So look, I think the bottom line of this whole argument is to say, here we have a Deutsche Bank analyst and a Citibank analyst, 2 professionals that have been analyzing the auto industry for decades combined. And they can agree on where Tesla should be trading. So I think what I want to say here is we have seen the quarterly results this week and Tesla trading as high as 1670 or 1680. And then in the last 2 days, just before heading into the weekend, we had a 15% drop from those highs. And I see a lot of people in online forums asking whether they should be buying the dip here and whether it's a good time to put money in Tesla on this 15% dip from the highs. I think given what Tesla has done over the last 12 weeks and how that share price has really skyrocketed, again, it's a little bit of an emotional decision. Should it be buying here? And is there really value in where Tesla is trading today? So I think the bottom line is, from a risk-reward scenario, I would not be buying Tesla up here. I think, like I said in the beginning, I love Tesla as a car company. I love the Tesla products. And I think Elon Musk is the modern Edison, sending us to Mars, digging tunnels under the city. I think it's an amazing visionary. But I also believe that you have to take the emotions out of the trading. And right now, where we are today, I would not be buying Tesla above $1,000. And I think when you look at the share price performance, as soon as we broke that barrier of $1,000, there was a huge gap higher. And I think that gap is going to get closed. So personally, I would be looking at buying on any dip that's a bit more meaningful, certainly below $1,000 if you want to own Tesla from a long-term perspective. So to wrap this up, this is a first video of many about Tesla. Like I said, it's a company that I love. I'm going to talk about Tesla much more in the future. So if you like this video, hit that like button, subscribe below the video to the channel so you get notified for the future videos. I thank you for your time and for watching this, and I'll see you in the next video.